Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set the agenda.
$1 trillion tech wipeout on the NASDAQ. The AI bulls get a fresh challenge. Global earnings add fuel to that fire. Results disappoint from autos to consumer and luxury. And China unexpectedly cuts its one-year policy rate by the most in more than 4 years to support the slowing economy. Good morning, Manus.
Danny, a very good morning. You know, the adjectives I used yesterday, those superlatives really probably weren't enough. We're trying to steady our feet at the moment. You're looking at over a 3% drop, 3.5% drop in the NASDAQ yesterday, $1 trillion wipeout. This really was a Jerry Maguire moment for equities. Show me the money. And Alphabet did not show you how they're going to get the capex to work. They lit the torch paper of a sell-off. It was the biggest sell-off in Mag 7 that we've seen, a record Mag 7 sell-off, $760 billion. But what you have, Danny, is a much more pervasive, and we'll talk more about this, a much more pervasive sell-off, whether it's Stellantis, whether it's Ford, whether it's Gucci and Kering in Europe. So there's a toxicity to the consumer as well. Now, to the bond market, 4.36% is where we are. Look, the flamethrower across the bond market yesterday was Bill Dudley, really, when he said, look, now is the time to act, the ex-Fed governor. But the curve is the closest to disinverting in 2 years. And again, we'll talk more about this, up 11 basis points yesterday. The 5-year auction was well received. 7 years come down the pike today. You probably see that well received in the belly of the curve. And this is really where the drama is. The yen has been rising for 4 days in a row. So this isn't just politics. This isn't just a rate cut. This is a much bigger risk trade, which is the unwinding of the carry trade, which will have more pressure on it because various people are going to be under pressure for VAR, the amount of risk that they can carry in these more turbulent times in these markets.
Manus, I think that's a really good point. I think the question needs to be asked this morning, how much of what we are seeing is due to the yen, is due to a deleveraging for a currency, for a carry trade that is being so unloved at this moment, that's used for funding in various things. And look, the trade to short yen, go long treasuries, go long U.S. stocks. It is a very common trade. So if the yen portion of it starts to be unwound, I think we're joking around this morning. Is there a bank? Is there a prop shop somewhere in Japan that's really feeling the pain this morning? Because you look at the Nikkei, down a lot this morning.
And this is the point. It's not just our markets here in the United States of America, whether it's the S&P, the NASDAQ, and the Russell. We'll come back to that in a moment in terms of whether it's large cap underperformance and giving the Russell the opportunity maybe to catch up. It hasn't worked out. The CAC is on the verge of a correction. The Nikkei has dropped the most in 3 years, and it's down almost 10%. So you can see this kind of catharsis in other markets. The question is, if they're down 10%, are we done? Are we done at $1 trillion off the NASDAQ? That's the question.
It is this feeling of markets coming unglued. We had these steady gains, record after record, something like 36 records, and it was steady and it was in a really tight range. All of a sudden, you see something change. You see volatility start to spike up. You see really big swings and losses, swings which hadn't been there. So the question needs to be asked, is this a turn in sentiment for a rally that had been so unloved, that so many people felt uncomfortable with? Is this the moment that you can finally sell those winners? And is that what we're seeing? And are you willing to go back in and buy the dip?
If we go back to Monday, you know, this week we've already seen one massive turnaround, one massive dip buying opportunity. People said, look, Nvidia was down 9% at the end of last week. Come in and scoop it up. Talking to various people on the IB this morning, talking to Tim Graff over at State Street. He's not panicking yet, but he is worried about this rotation, this particular rotation, because the volatility, the volume and the correlation are rising off a base that he says he's not there yet at the point of where he actually wants to panic. So hold your nerve would seem to be the tentative take at the moment.
Well, this is one of the things I was more shocked by. If you look at what the small caps, specifically banks, have done, if you look at the banking index, it's now outperforming the NASDAQ for the year. And this gets to this thing. I mean, some of the concerns about the regional banks, they are still there. It's not like this concern over what you're holding is for some reason gone away. So do you know what you're actually owning by buying some of these small caps? I mean, again, a world where banks are doing better than tech, you have to imagine that comes down to rate cuts, but how comfortable are we going to stay with that?
Well, then you look inside the banks and you talk about what's going on with the real consumer. We'll talk to Mike McKee a little bit more about this. Credit card late payment on your credit cards out there in the United States is the highest level since 2012. So if you take some of the manufacturing data that we had yesterday, I know services is still doing a little bit better, but then you look at really what's happening with the consumer. We've had 356 sessions of no dip, of more than 2%. Well, that's just been corrected.
It goes back to what Mohammed El-Arian says. Pay attention to what the companies are saying. And the companies, the breadth of which is quite shocking, man, is everything from luxury to autos. And at the same time, some of these consumer staples, all of them are saying price fatigue is real and people aren't willing to spend up.
Yeah, just look at Stellantis and Ford. We'll talk more about that in a moment. Bring back the gas guzzlers, never mind your EVs. That seems to be a sentiment. OK, let's talk about the President of the United States, Joe Biden. He framed his historic decision to step out of the 2024 race as a bid to unify the nation under a new generation of leaders. Here's what he said last night in his first speech since ending his re-election campaign.
I've decided the best way forward is to pass the torch to a new generation. That's the best way to unite our nation. You know, there is a time and a place for long years of experience in public life. But there's also a time and a place for new voices, fresh voices, yes, younger voices.
A very gracious exit. Vonnie Quinn has been tracking all the news flow overnight from Washington. Vonnie, good to see you. I mean, just listening to Biden, his speech marks the end of his career, and all that's left is Harris versus Trump. So what is the latest in terms of the campaign?
Well, indeed, Manus, it marks the end of his career to some extent. There is 6 months left, and what he did with his speech was actually quite clever because he was preemptively fending off some of the attacks that Kamala Harris is having to face already. He is passing the baton, in other words, not just to a younger generation, but to the American people. He said several times in his speech that democracy was paramount, and defense of democracy was very much the theme of the speech. He said literally the great thing about America is here kings and dictators do not rule. So there was a tacit implication that, there might be some kind of a threat out there behind everything. But yes, Kamala Harris and Donald Trump are left to fight this out between them. And I do want to point to the fact that President Biden did make some messaging related to what Kamala Harris is going to have to face. So he pointed out in his speech that they did lower the racial wealth gap during his administration, the cost of prescription drugs, the violent crime rate, all of those were lowered. And he mentioned that border crossings were lower now than when the previous administration left office. So again, to illustrate some of the attacks that the president is clearly trying to fend off on behalf of Kamala Harris, let's have a listen to what Donald Trump had to say at a North Carolina rally around the same time as the Oval Office address, in fact.
She's a radical, crazy person. When you compare my position on abortion to that of Kamala Harris, my position is 8 points higher in the polls.
Well, there you're hearing something very unusual. You're hearing Donald Trump speak about abortion because he knows that's an issue that he will have to take on because it's one of Kamala Harris's strongest points. But if you also notice, he mispronounces her name. He does this constantly. It's an extraordinarily insulting thing to do to any candidate. He also attacks her on energy and climate change, healthcare, inflation repeatedly, and of course, border issues and immigration. It's scaremongering when he talks about her being more left than Bernie Sanders. We don't know what her economic platform is yet. We assume that some of it will be, of the ilk that Biden had proposed during his platform. But she is a whole different person. She hasn't even hired her economic advisors yet.
Vonnie, Terry Haynes of Pangea wrote that Biden's 11-minute speech was an explainer speech and went on to say that it is a weakened U.S. leader that makes geopolitics troubling, because often there are situations where people take advantage of weakened leaders. On that note, Netanyahu was in Washington, D.C. for what for some was a very controversial speech. Let's just take a listen to that, Vonnie.
I thank President Biden for his heartfelt support for Israel after the savage attack on October 7th. He rightly called Hamas sheer evil. He dispatched 2 aircraft carriers to the Middle East to deter a wider war. And he came to Israel to stand with us during our darkest hour, a visit that will never be forgotten.
The noticeable absent, Vonnie, to that, though, was that he didn't mention the ceasefire plans. And we know this is what Biden is concentrating on now. So how does this evolve with Biden's final months?
Biden has been concentrating on it for months, really since the beginning of Israel's war on Hamas. But you mentioned weakened leaders. you're seeing another one in front of you, right? This was as much a speech for Netanyahu's domestic audience in Israel as it was to the joint houses of Congress. By the way, at least 36 Democrats boycotted this speech, and there was plenty of protests outside and in and around the halls of Congress as well on Wednesday, thanks to Netanyahu's visit. But you mentioned the fact that perhaps Donald Trump is perceived to be stronger on foreign affairs issues. We did have current Secretary of State Antony Blinken come out and try and give Kamala Harris credit for her work on foreign policy issues, saying that in the Situation Room, for example, she would be asking very piercing questions and really trying to support her before we know what her foreign policy will look like and who her foreign policy advisors will be. But Trump, in polls, does seem to be trusted more on foreign policy issues. However, he has a problem with Bibi Netanyahu himself. He felt like they were great allies at one point, and then he felt that Bibi had really let him down. He had moved the embassy to Jerusalem. He had offered Benjamin Netanyahu a lot of support, and Benjamin Netanyahu turned around and congratulated Joe Biden on winning the election. He has also had an extraordinarily strong relationship with Joe Biden. So when Netanyahu goes to Mar-a-Lago on Friday to meet with Donald Trump, assuming that both of them are in office or one of them is still in office in 2025, he is going to have to make sure that Donald Trump will be on his side.
Certainly, Vonnie, we appreciate it. Vonnie Quinn in Washington, D.C. Okay, let's get to some of the other top stories that are trending on the terminal this morning. China made another move to boost the economy overnight. The PBOC unexpectedly lowered the cost of its one-year policy loans, this time by the most since April 2020. It comes just days after it cut a key short-term rate last Monday.
Nestle lowered its sales outlook for the year as consumers balk at the price increases on branded food, water and pet care products. The world's biggest food company now expects sales to grow at least 3%. That's lower than roughly 4% as previously guided.
And Bernard Arnault's net worth has plunged this year by anyone else on the Bloomberg Billionaire Index. The French tycoon has been squeezed by souring demand for luxury goods, seeing his fortune drop $20 billion during 2024 to just a meager menace, $187 billion.
I'd take an end to that. Speaking of luxury, Danny, Swetha Ramachandran joins us from Artemis Investment Management. We're going to dig deeper into the carrying earnings, the LVMH outlook, and what's going on really under the hood in China.
It's painful in consumer. It's also painful in tech. We'll also catch up with Matt Maley of Miller Tabak later in the program to discuss the widespread sell-off here on your Bloomberg Brief. Welcome back to your Bloomberg Brief. It has been a rough run for consumer stocks, but now the focus is on luxury. Kering tumbling this morning with earnings that missed. The Gucci owner is struggling, but they're not the only ones. LVMH also had earnings yesterday that painted a dour picture. Here's what the CFO had to say in their earnings call. The aspirational customers in the U.S. is a little under pressure due to inflation and higher rates that are both taking a toll in terms of their purchasing power, particularly in the U.S. and to a lesser extent in Europe. Some brands, particularly in the U.S., are paying the price for this situation. Let's get to Swetha Ramachandran of Artemis, who covers the luxury sector. Swetha, we talked about this in quarters past, that it is a more choosy consumer. Is something changing now? Because it's not just luxury, it's not just Kering, it's LVMH and it's Staples. Is something bigger happening here?
Yeah, I think there's this theme that's been emerging in recent months of sort of customers hitting a wall in terms of price resistance. Cumulative inflation has taken its toll, and consumers who are no longer flush with excess savings post-pandemic, except in China, which is a special situation because there it's really a lack of confidence, not a lack of ability that's impeding that spending power. And consumers in much of the developed world have really kind of reached sort of a point of resistance where these high prices means sometimes it's worthwhile forfeiting spend. But even in this environment, it's not the case that people are pulling back indiscriminately. We can see actually the variation has been quite substantial. If we look at sort of Burberry and Kering's like-for-likes, which are down 21 and 20% respectively for the second quarter. On the other hand, you've got Brunello Cucinelli up 12%, Moncler up 5%, even the Louis Vuitton fashion and leather goods segment somewhat creditable at plus 1%, which is still sort of a percentage point gap with the brands that are really losing out at the moment.
Swetha, good morning to you. When you look at these differentials, Bruno Cucinelli, Hermes will report later on, there is this bifurcation that you refer to, and I just wonder, does the moat around Hermes, Bruno Cucinelli, etc., grow relative to the likes of Burberry and Kering that have obviously the troubled child of Gucci in there? Does this differential just grow? Because they're not struggling at the top end. They've got the right product at a pretty hefty price.
I think in a slowing market, which is where we are right now, it's fair to assume that these brands that are exposed to a more inelastic, resilient consumer will perform better. I mean, this industry is ultimately cyclical, so the cycle will turn at some point when the spending taps loosen again. And at that point, it's possible, we should see, for example, the fruits of the restructuring and the turnaround the Gucci brand in particular, as well as Burberry, are engaged in, start to bear some fruit. But it does seem, at least for the foreseeable future, that sort of ebullience that we saw in the wake of the pandemic is not quite there yet. And as you mentioned, it's not just for the luxury goods sector. We're seeing this with Nestle this morning. Even Ryanair, in a completely different category earlier this week, warned to the fact that it would have to start discounting fares in order to get consumers moving again. So it seems to be much more broader based than just restricted to luxury.
The ebullience is there for traveling to Japan, Swetha. It has been remarkable. Looking at these earnings, I mean, the LVMH CFO basically said that people are saving up, holding their money for the next time they go to Japan so they can stay there. And even going so far as to say, look, our price rises aren't keeping up with the depreciation in the yen because it's swinging around so much. For how much longer can these companies rely on Chinese travelers and other travelers, because I'm sure we all know someone who's gone to Japan recently, helping to hold up some of these results?
So the Chinese tourist spend is not really a new feature of this industry. Prior to the pandemic, about 2/3 of what Chinese consumers were spending on luxury products was taking place outside of China. It's just that in the last 4 years, we have seen all of that repatriated back to the mainland because of the restrictions on travel as well as outward mobility, which of course have reversed again. And Chinese consumers, being rational, are constantly seeking price arbitrage. Prices typically tend to be cheaper in Europe and in Japan because of the structure of customs and other tariffs domestically, which prompts them to seek the best prices abroad. And right now, it happens to be that Japan is the hotspot, where thanks to a combination of the weak yen as well as duty-free shopping, the price differential on the same product could be as much as 35 to 40% versus buying it at home, which again diverts that spend abroad. That can create a problem in the short term because margin structures are not the same around the world. Cost structures, rents in particular, are variable in Japan versus being fixed in other parts of the world. So you don't necessarily get that same operational leverage. And plus, of course, the weak yen means also when translated into euros, which is their reporting currency, it's effectively worth less. But the recovering Chinese consumer is absolutely going to remain a theme for the sector. And even with LVMH, it's not all doom and gloom. They're still seeing growth with the Chinese cluster, which is actually a bright spot in the sector, given their resuming outward travel.
So let's see how it goes. We didn't quite get to the hard luxury point, but I didn't realize that emotion came into luxury purchases. Or sorry, common sense came into luxury purchases as well. It's all about the emotion for me. Swetha, thank you so much. Swetha Ramachandran there of Artemis on those big luxury stocks this morning. We've just had a quick line from Mohamed El-Erian. It's an op-ed, pretty much the same timing as we had yesterday with the former New York Bill Dudley Fed governor. But this time, Mohamed is saying it's very much in line with his whole thesis, which is they're encroaching towards policy area. The headline on this is the Fed may be 2 meetings away from a policy mistake. But he has been banging this drum quite aggressively.
He has. But to be clear, he's not as forceful as Bill Dudley. Bill Dudley yesterday, the former Fed speaker, said that they should be cutting in July. Mohamed says What's the difference of a few months? He says, while waiting for September is not a major issue in the grand scheme of things, a delay beyond that would be the bigger concern. So basically, he writes, they have to cut by September.
And that's when you walk into the land of potential policy mistake. We'll tell you what's on the front pages of your global newspapers in just a moment. Hang with us. It's Bloomberg Brief. It's Bloomberg Brief. I'm Manus Cranny alongside Danny Berger in New York. Your front pages look a little bit like this, apart from a market meltdown. It is once a harsh critic of electric cars. Donald Trump seems to be softening on them, even recently calling them incredible. The former president has spent years ridiculing EVs, saying they don't go far, they're pricey, and they're made in China. Subtle softening in the tone, isn't it, Danny? And of course, he's going to be having a bit of dinner with Elon quite soon.
And Musk himself has said that he has donated to one of the Trump PACs. I wonder how much that has changed things. Okay, next up, the NBA has linked a $77 billion TV and streaming rights deal with NBC, ESPN, and Amazon. It goes into effect for 11 years, starting in 2025 to the 26 season. The last-minute bids came from current rights holders Warner Bros. Discovery, was turned down, setting the stage for a potential legal showdown, Manus.
Chunky amounts of money. And the FT says this. The brasseries of Paris, they're struggling to contend with a city which is in lockdown. This is ahead of the Olympics. You saw this in London, Danny, a number of years ago. But you're looking at, what, a 50% drop in the brasseries, and the hoteliers are calling for compensation.
Well, the concern is even once the Olympics get going, the people aren't showing up. There was that story yesterday that hotels were down 41% from their pre-Olympic peak. So I don't know, not as many people want to get to Paris.
Let me tell you this, though. A night in Paris in a four-star hotel is €313. That is still a lot cheaper than London or New York. But the occupancy
compared to New York, everything's more expensive here.
But Paris has a touch of beauty.
Yeah, better croissants.
Yeah, we'll have a croissant.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
It was $1 trillion tech wipeout on the NASDAQ. The AI bulls are squarely challenged. Global earnings add fuel to the liquidation fire. Results disappoint from autos to consumers and luxury. And China unexpectedly cuts its one-year policy rate by the most in more than 4 years, in a sign of their further support to the slowing economy. Everywhere you turn, Danny, this sell-off has been pervasive in the past 24 hours.
At least we are calming down when it comes to this equity market. How long will it last, though? Your NASDAQ futures basically unchanged. Same with your S&P 500 futures. Russell, though, it is outperforming. It is this feeling of things having come unglued. We had no more than 2% drops in the longest streak since the great financial crisis. We broke that yesterday with a bigger than 2% drop. Your Mag 7 had its worst day since September of 2022. It was a really tough session everywhere you look. Also, for anyone who wanted to put flatteners on, the curve steepened by a huge amount. One of the closest to zeros right now on this U.S. yield curve since July of 2022, when the flattening first started to really happen in force with that inversion. The long end didn't save you in the sell-off yesterday, but the front end did come down. It continues to come down this morning. We're down by another, let's call it 7 basis points. 436% is where we stand, and still the yen getting slammed. George Seavalis from Deutsche Bank points this out, that the Aussie versus the yen has appreciated some 7% in the past 2 weeks, the most since 2016. That is a very odd move for something that hasn't really had a catalyst. He points to Trump's interview in Business Week as being the thing that kicks this off. Even if that kicked it off, Manus, is this a bigger deleveraging that we are witnessing in the market? If you have the yen gaining by 1%, the carry trade coming undone, hitting things like Bitcoin, hitting things like gold. Again, there's a feeling in this market that things are coming unglued.
Yeah, I mean, the unwinding of that carry trade, we talked about it yesterday, is significant because it has the ability to really batter across assets. 24 hours ago, Bill Dudley, the former New York Fed leader, he really threw a flamethrower over the short end of the curve. When the facts change, it's time to change direction. And that's where he called for act now, even in the July rate meeting. And here, 24 hours later, literally to the hour, we got Mohamed El-Erian saying, you know, we're about 2 meetings from a policy mistake. But clarity around this statement, I think, needs to be made. He still says that a soft landing for the US economy could too easily slip away if unhelpful. In other words, they need to actually act. But the question is now down to timing. There's a bit of a marker there. There's a bid on July with an offer on September from Mohammed.
Yeah, failing to ease policy in either July or September, and an outcome that unfortunately can't be ruled out would constitute another policy mistake. This one's interesting to me because Bill Dudley says that they should be easing in July. Mohammed says they can ease in July or September. The couple months won't make a difference. There's not too much chatter about there, though, of them not easing in September.
No, and if you look at these jolts in the market, and not that the Fed's going to react to jolts in the market, they're going to be quite happy to some of the air coming out of the wealth tower, some of the sort of the frenzy that you've had in stocks in the Mag 7. They're going to be quite grateful for this sort of moderate drawdown, 3.5% on the Nasdaq. Globally, you know, what's that, $1 trillion on the Nasdaq? Globally, you're looking at even bigger numbers, corrections in the Nikkei, corrections in France. So this air just coming out of the towers. The question is whether it's a secular and structural downturn in the equity markets, or is it just a pause?
Well, the good news is that the Fed is on a blackout period. So at least we don't have Fed speak ahead of their meeting next week. Let's bring in Bloomberg's Mike McGee, because there's a lot to go through. I just want to start on this L-Arian column, because, Mike, his argument is basically that the unevenness of the data could scare the Fed into not cutting in September. Can we just be clear that all expectations are that they probably will cut in September?
All expectations are that they probably will cut in September, although it's interesting, and I don't know if they can pull up my last chart here, but basically what's happened over the last 24 hours is Bill Dudley scared the markets or reinforced their belief. And so you see the 2-year note yield falling quite a bit, and then you see the Fed funds futures and OIS up at the top there telling you that they haven't moved at all because they've already priced in a move. And basically, that's the argument from a lot of analysts this morning, is the Fed doesn't have to move next week because we did. We've already priced it in. Now, the interesting thing today is going to be that we get some data that's going to kind of reverse the gloom, maybe, unless people are just accepting of it too much, because we get GDP supposed to come in stronger than expected. We get the personal spending component of that better than expected. Jobless claims supposed to go down again. And then core capital goods, the most important part of the durable goods order, are expected to turn around from a negative last time. So we could have, by 8:30 this morning, maybe a little bit of a different attitude that a crisis is not upon us, a recession is not upon us, as Mohammed suggests and Bill Dudley even suggested, but we do need some kind of help.
But this is about ensuring, and if you look in, I mean, we'll all have time to read the article in a little bit more detail, but the likelihood of a soft landing for the economy and preserving the US economic exceptionalism would be considerably higher if the Fed were not encumbered by outdated inflation targets, all ill-suited monetary policy framework. I mean, again, this is reiterating, as he has done on many occasions, about anachronistic data and out-of-date practices. So again, he's reinforcing that they're looking at data that perhaps isn't fit for purpose.
Yeah, that's going to be a real debate this fall when they start their review of their policy framework. The people I've talked to at the Fed think that there has been a worthwhile discussion of whether you should raise the inflation target, but they don't think they need to do that because they think they can get back to 2%. And if they go to 3%, then that's moving the goalposts. And so at this point, that part is maybe unlikely to happen. They also push back on the idea that they're overly data dependent, and that they talk about how much they talk to CEOs and business people to get the current lay of the land. And we saw in the Beige Book a pessimistic view from most of the districts. So they've got the idea that things are slowing down and maybe it's about time to cut rates. It's more a question of when.
Well, if you look at the Philly Fed data on credit cards, those balances are at the highest now since 2012. So the consumer, we know this, the consumer is under a lot more pressure at different levels within the consumer spectrum. Mike, thank you very much for joining us this morning, reacting to the Mohammed Al-Arian op-ed. Our guest this morning is Matt Maley, Chief Market Strategist over at Miller Tabak. Matt, good morning to you. A 3.5% drawdown, $1 trillion wipeout on the Nasdaq. Japan's in correction. Paris is in correction. You panicking or stoic?
Well, as you know, as you say, there's no reason to panic, but there are certainly some reasons to be concerned out there. I mean, the what we saw from Tesla and Google, I should say, Alphabet, with their earnings. It's just starting to show that something that I've been worried about I've been talking about for several weeks is, are these tech companies getting the return on investment, this massive investment they've made in AI? Are they getting it quick enough to justify the incredibly high levels, they're expensive levels for most of these names that exist today? And then, of course, you have what you guys have been talking about, this carry trade. I mean, there's still a lot of leverage in this in the marketplace. And when the carry trade starts to wind down, as you guys have mentioned, people unwind that leverage. And that could tip things into a situation where you could see an acceleration of selling. And so it's something to be concerned about.
How do we know when we're there, Matt? And I ask that because this has been a really steady market that not only has not dropped by 2% before yesterday, since in the longest stretch from the great financial crisis, but also hasn't rallied that much. We've just been stuck in a range, and there's this feeling of things coming undone, of an ungluedness to this market. How much do you want to be concerned with a sentiment change, of something that can lead to a broader and more consistent sell-off than just yesterday?
Well, I think, the change in sentiment is very important because, I mean, let's face it, when a market is really, really expensive as it is today at 23 times earnings, or about 22 times earnings, whether you look at 2024 or the next 12 months, either way, it's very expensive. And price to sales is about 3 times sales. So very, very expensive. We need that sentiment to be bullish. And, it's interesting. You've been talking about the difference between Mohamed El-Erian and former President, New York President Fed Dudley. I mean, Mr. Dudley seems to be indicating that it doesn't matter when the timing comes. It might already be too late. So if we start to see, what we see what's going on with China, they seem to be suddenly, I say panicking, but they're definitely cutting rates suddenly twice. And earlier it was just a slight cut, earlier less than a week ago. Now a big cut, and suddenly we're talking about maybe a sooner cut, a July cut in the U.S., or maybe 50 basis points in September. I guess the concern is what's going on with the economy. Is it really slowing a lot more quickly than people had been thinking? If that's the case, sentiment's going to change very quickly.
Well, when you look at Ford's numbers, when you look at Stellantis numbers, I know Mary Barra delivered a different set of numbers, and so 2 out of 3 sends me a kind of message. When you look at those kind of numbers, you look at Nestle, you look at the price the price reluctance that we're pushing back at. Would you say that we are at the start of a soft landing, or something a little bit more significant to come?
Well, I think it's probably something more significant to come. Now, does it happen immediately? Does it happen, next year? That's always hard to say. But, not only the issues you've mentioned with Ford, et cetera, but look at the Visa and MasterCard. Well, Visa especially, because they just reported, but their stocks have been going down for a couple of months now after having great runs. And that's kind of signaling to me that the consumer is starting to lose a little bit of steam. So all these things, and the other thing I do want to highlight, very, very important, because I know, Danny, you've been talking about the yield curve. The one thing that people have been saying is, don't worry about the yield curve. It doesn't matter anymore because it's been inverted for a long time and we haven't seen a recession. But what the real rule on the yield curve is not when it becomes inverted. That's a preliminary signal. It's when it goes back into positive territory. Yeah. That's usually when we have the real problems, and we're getting closer to that. So if people look at that rule the way they really should, it's definitely something to be concerned about.
So, Matt, if I put all this together, a yield curve that is starting to be concerning if it is uninverting, an economy that looks like it might do something worse than a soft landing, can I really be buying small caps if all of that is the case?
I really don't think you can. And, because let's face it, the small cap stocks, the Russell 2000 companies, I mean, they get basically all of their revenues from domestic sales. So if the economy is slowing, that's not going to be good for them. And a lot of these companies, I mean, it's like 40% have lost money over the last 12 months. So these are the types of things that definitely concern me because, people are talking about rotation. Rotation is a lot different than broadening out. Last week we had some rotation. That's great, but what you need to see is the tech group stabilizing or moving up just slightly, and the rest of the market playing catch up, like the Russell 2000. But if they're going in different directions, that's just rotation. That's not good. And eventually, because of the huge weighting we have in the big cap tech names in the S&P and the Nasdaq, that causes those indexes to go down. That puts fear into the market, and suddenly people start thinking, something, I'm not going to rotate into small caps. I'm going to rotate into 5% cash, which really isn't too bad and a lot better than it was when it was given as zero just a couple of years ago.
Yeah, just when everyone was arguing to get out of cash, they get smacked in the face. Matt, great to catch up with you this morning. Good luck for the rest of this week. Matt Maley of Miller Tabak. Okay, coming up, the PBOC makes another surprise rate cut. We're going to take a closer look next on your Bloomberg Brief. This is Bloomberg Brief. I'm Danny Berger alongside Manus Craney in New York. So, Manus, we got a surprise move by China's central bank overnight. The PBOC cut the cost of its one-year policy loans by the most since April 2020. Just last Monday, it cut short-term rates. Let's get over to Bloomberg's Justina Lee. Justina, everywhere you look, you can see the weakness, be it in the data itself or what some companies are telling us about Chinese consumer. So why now deliver this size of rate cut?
Yeah, I mean, Chinese policy decisions are always interesting because there's no schedule and there are so many different tools. So this is coming after China cut kind of the rate on the short end this week. And so I think kind of if you look at the whole picture, what this tells you is the Chinese policymakers are really stepping up this coordinated effort to boost growth after we saw kind of pretty disappointing GDP numbers earlier. And I think another interesting point is that the currency market really is giving them a bit of an opening here, right? Because we've seen the dollar weakening, and now we're expecting the Fed to cut rates once or maybe twice this year. And so this really is relieving pressure on the Chinese currency and giving policymakers a room to deliver these rate cuts.
Good morning to you. Good to see you. It's interesting that this is more an FX lever that they're pulling rather than a growth lever, because the 20 basis point cut in the MLF is 0.2%. This is the analysis by Bloomberg Economics. 0.2% in terms of growth over 4 quarters. So it's the end of the third plenum. Is this step one, mini step one, of a multiple step process that you can see coming from the PBOC?
I mean, generally, economists are not really expecting a lot more monetary easing, like maybe, a bit more of a cut, further along the line this year. And I think this is why, you've seen so much weakness in the Chinese stock market because, Bloomberg Economics said this week that, investors want a big bang, and all of these are like little bangs. And I think that really is the issue here, because we've had kind of this big Chinese policy meeting last week. But at the end of that, you didn't really get any truly decisive measures to boost growth. I mean, we heard a bit about kind of supporting local governments, but this really kind of falls short of what investors are waiting for to put money back into the Chinese market.
Yeah, there was no bazooka there. There's no bazooka to solve the housing or indeed the wealth dissipation issue in the Chinese middle class. Justina, thank you very much. Justina Lee with the very latest on rate moves from the PBOC. Back to earnings. Stellantis taking a hammering this morning. Net income fell 48% in the first half. The automaker said it's now considering price cuts as it introduces more new models. Craig Tudell is with us to talk through this. I mean, Danny and I were just focusing on this in terms of the models and what's happening overall in the auto sector. North America is where the real pain trade is for Stellantis. How much pressure on the under, and will price cuts cut the mustard?
Yeah, I think this is a case of a company that is very truck and SUV heavy and focused, that has had some trouble keeping up with increased competition. So you think about this company as really a Ram pickup and a Jeep SUV manufacturer. And on the Jeep side, you have Ford bringing out the Bronco, and that really sort of changing the dynamics of that more off-roady SUV segment. And on the pickup side, I think, it's just never been more competitive in terms of, Ford and General Motors, and Ram really going at it. This is a case of a company that also was just, really pushing volume beyond, what the market was ready to bear. And I think we've sort of realized that, we're pushing up against the limits of how much further new vehicle sales will go in the U.S., and Stellantis hasn't really taken their foot off the gas. And so, you're going to see some price cuts, and perhaps if that is not effective, maybe, taking down some shifts and unfortunately cutting jobs.
Well, some of this is about changing taste or maybe lack of change into EVs, that you have them talking about bringing a Dodge Charger back into the market, that they don't think their new lineup is robust enough. But Craig, can we understand how much of it is just taste in the U.S. of what a consumer wants to buy versus just flat out consumer weakness, people not wanting to make big purchases like cars right now?
Yeah, I think it's definitely a little bit of both. I do think that the U.S. market is far from in a weak position where, the automakers love to see, a seasonally adjusted, annualized rate of 15, 16 million. That's a very healthy market for them. But this is a case where, Stellantis also was very much, sort of behind the curve from an EV perspective, and we're sort of very much needing to get in the game there. Unfortunately, they're entering this space at a point where momentum has really slowed, and you want to talk about more competition. They're very late to the game and have quite a bit of players that they're moving up against. And so, can they really sort of expect to get the pricing that, 2-3 years ago they were expecting? Probably not. And at the same time, also having to kind of, make a judgment call about where policy is going in the U.S. Things are going to be very different depending on whether or not we have, former President Trump in the White House or a Kamala Harris administration in terms of, how strict emissions policies will be and whether or not they need to really follow through on these big EV bets.
Yeah, fair enough. And then you have Trump softening some of his tones on EVs yesterday. Craig, we appreciate it. Bloomberg's Craig Trudell. Let's take a quick look at these bond markets because yields are moving lower across the curve, yet the curve does continue to steepen. It is the most steep since July 2022, the closest to zero. Manus, I think the interesting thing about this is yesterday that duration did not save you. That 30-year yields moved quite a bit higher yesterday. It got a pummeling. And if you're looking for pockets of safety, you'd think duration could be one, but you get this feeling that people have just loaded up on duration. And anywhere where people were really heavy in the market yesterday, they sold.
They got taken out. I mean, that curve moved by 11 basis points in terms of the shift. As the conversation that we've just had with Miller Tabak, which is it's not necessarily the inversion, which obviously we've waited for, 2 years? I think it's one of the longest that we've seen. It's what happens when we go to this flattening. So we're kissing the point of where we can disinvert. And what does that mean?
Yeah, I mean, it's these warnings about the economy. I think Bill Dudley, as you said, really put the bond market on fire.
Yeah, I mean, that was a flamethrower that he threw over it yesterday. He's going to be on surveillance a little bit later on, so it's going to be interesting to hear the qualification on that. What else have we got? Well, we've got a little bit of time left for you, so it's a big earnings day from New York and from Europe. We'll put a bit of context around it for you. We'll wrap it around. SPOO's dropped by an eighth of 1%. Good morning from New York.
Welcome back to Bloomberg Brief. Danny Berger and Manus Cranny in New York. Okay, let's get you set up for your trading day on this Thursday. We're going to get a lot of data that includes U.S. GDP, initial jobless claims, and durable goods orders. All of those are at 8:30 a.m. Eastern, plus more airline earnings, something to watch after weak results from others, American and Southwest, both before the bell. Then President Biden welcomes Israeli Prime Minister Benjamin Netanyahu to the White House with a meeting at 1 p.m. Manus.
Danny, it's been carried out quite literally if you long the dollar, excuse the pun. This is, of course, dollar yen. You're looking for a rally in the yen 4 days in a row. This is about the unwinding of the carry trade across markets, not just in FX, but it is pervasive across markets.
What happens when your funding currency takes a beating? Maybe it looks something like this, like multiple assets falling, Bitcoin and gold both down quite dramatically this morning. Not to mention equities yesterday. It is a sell-off across the board with little places to hide. And I think that's part of the issue, that there wasn't a lot of safety in the market yesterday.
Yeah, I mean, when gold drops 1.3, but when you've got this risk-off sentiment in equities and you've got shifts in the bond market and still gold and yen drop, it says it is about a reduction in VAR. It is a reduction in overall risk taking in these markets.
And the fundamentals aren't helping. If AI isn't living up to its potential, that had been the thing carrying this market. So that's when you get worried.
Yeah, $760 billion wipeout yesterday. Would you call it stability? We can debate in the next 3 hours.